In 2015, the EPA finished counting something most people have never thought to ask about. How many underground fuel tanks in America are currently leaking right now into the ground beneath a business someone owns? The number was over 57,000, not resolved, not cleaned up, sitting there. Under federal law, if you buy a gas station and one of those tanks is leaking beneath it, a leak that started years before you signed anything, the cleanup bill belongs to you, not the previous owner, not the oil company that supplied the fuel, whoever holds the deed when it's discovered. That single legal fact is the key to understanding why a gas station is not the business it looks like from the outside. Most explainers on this business stop at one number. Gas stations make 3 to 7 cents of profit per gallon. It's treated as a fun fact and the video moves on. After going through the actual cost structure, the EPA's own cleanup data, and the industry's own revenue reporting, my take is that this framing buries the real story. The thin fuel margin isn't the interesting part of this business, it's the least interesting part. The real story is a business that was quietly rebuilt into something else over about 20 years while keeping the same sign, the same pumps, and the same name out front. And underneath that transformation sits a legal liability that most people who fantasize about owning one of these have never once priced into the decision. So here's how we're doing this, what it actually costs to open one, why the product it's named after barely pays for itself, where the actual profit lives, what's sitting in the ground underneath a huge share of these properties right now, and the trend now bearing down on the entire model.
Let's start with what it actually costs to get in. Building a gas station from the ground up runs $1 to $3 million in construction alone. Site preparation, the canopy, the convenience store structure, the electrical and plumbing infrastructure, that doesn't include land. In a high-traffic suburban location, land alone runs $500,000 to over $1 million. Then there's the piece almost nobody accounts for, what's underground. Every station runs on underground storage tanks, USTs in EPA terminology. A standard 10,000-gallon double-walled fiberglass tank runs $25,000 to $40,000 per unit before excavation, installation, piping, and permitting. Added up, and underground infrastructure alone costs $150,000 to $250,000 on a typical new station, and a full-service location needs multiple tanks, not one. Add the pumps, 6 to 12 dispensers for a full-size location at $15,000 to $25,000 each. Total equipment and tank costs land between $300,000 and $750,000. Put it all together, land, construction, tanks, pumps, permits, insurance, and 6 months of working capital, and you're looking at $1.5 to over $4 million just to open the doors, and you haven't sold a single gallon yet. Here's where the counterintuitive part of the business actually lives. Gasoline is a commodity. The station owner didn't refine it, didn't transport it, has almost no control over what it costs wholesale. If you're running a franchise station under a brand like Shell, BP, or Chevron, your fuel price is largely set for you. Your supplier is chosen for you, your store layout is dictated to you in exchange for brand recognition and a guaranteed supply chain. If you're independent, you negotiate your own deals and set your own prices, but you're building customer loyalty from scratch on a product where most people choose a station based entirely on price and proximity.
Either way, net profit margin on fuel sits under 2%, and it hasn't meaningfully moved in decades. In 2024, the average U.S. pump price fell 6.5% from $3.55 a gallon to $3.31 a gallon. Total industry fuel revenue actually dropped 5.7% that year to $501.9 billion, even as gallons sold ticked up slightly. Volume went up, revenue went down, because the margin per gallon barely moves regardless of what crude oil is doing. When crude prices spike and customers are furious at the pump, the person absorbing that anger, the station owner, is keeping roughly the same few cents they were keeping before the spike. The pricing pressure is happening upstream at the refinery and distribution level. The owner is a pass-through, not a beneficiary. So if the fuel isn't the business, what is? This is the part the industry's own data makes almost impossible to argue with.
In 2024, convenience store in-store sales reached $335.5 billion nationally, the 22nd consecutive year of record in-store sales. Total combined revenue for the industry, fuel, and in-store together was $837.4 billion. Food service specifically made up 28.7% of in-store sales, but 39.6% of in-store gross profit dollars. In 2004, food service was just 11.9% of in-store sales. That's a full strategic pivot executed in plain sight over 2 decades, and most customers walking in for a coffee have no idea they're watching it happen.
The gross margin on a bottle of water or a cup of coffee runs 30 to 50% against under 2% on fuel. A customer who fills a tank for $50 and grabs a $4 coffee has just generated more profit for the owner on that coffee than on the entire fuel transaction. Buc-ee's shows what this model looks like at its logical extreme. Their largest Texas locations run up to 120 fueling positions and 80,000 square feet of retail space. Food service and merchandise generate so much of their revenue that fuel is close to incidental. They're not really a gas station anymore. They're a retail destination that happens to sell gas as the reason people get off the highway. The average independent operator lives at the other end of that spectrum. After fuel costs, payroll, utilities, rent or get service, insurance, and card processing fees, a typical owner takes home $60,000 to $150,000 a year. A strong location can push that to $200,000 or $300,000. A weak one can fall under $50,000 against a business that cost $1.5 to $4 million to open. Now, here's the part almost nobody factors into buying one of these. The useful life of an underground storage tank is 25 to 30 years. Roughly half of all existing U.S. gas stations have tanks at or past that threshold right now. These tanks corrode, they crack, they leak, and the fuel migrates through soil into groundwater that nearly half the U.S. population depends on for drinking water. Wells across the country have been permanently shut down because of exactly this. The EPA's average cleanup cost is $154,000. If groundwater's involved, that range jumps to $100,000 to over $1 million. More than 57,000 confirmed leak sites nationwide are still waiting for full remediation, even after more than 516,000 have already been cleaned up since federal regulation began in 1984.
Here's the liability structure that makes this different from almost any other small business acquisition. Under federal law, the person in control of the property at the time a leak is discovered is responsible for the cleanup, regardless of who owned it when the leak actually started. Not the previous owner, not the oil supplier, not the tank manufacturer. Whoever holds the deed the day it surfaces. A slow underground leak produces no visible sign from the street. Someone can tour a station, sign the paperwork, and inherit a 6-figure environmental liability the moment the deed transfers, one that might not surface for years. This is why environmental due diligence, typically $15,000 to $20,000 for proper soil testing, isn't optional before buying an existing station. It's the difference between buying a small business and buying a lawsuit with a delayed fuse. Federal law also requires owners to carry a minimum of $1 million in cleanup insurance per incident. For stations with aging tanks, that coverage can be prohibitively expensive on the open market, expensive enough that several states have built publicly funded programs specifically to subsidize UST insurance, because private insurers won't underwrite the risk at any premium they consider reasonable. There's one more shift worth naming, because it changes the calculation of whether this is a business worth buying into today. In 2024, global EV sales passed 17 million units, over 20% of all new car sales worldwide. In the US, EVs made up roughly 10% of new car sales, growing every year. Boston Consulting Group projects up to 25% of U.S. fuel retail stations could become unprofitable by 2035 as gasoline demand declines, with fuel profits falling as much as 60% in the fastest adopting markets. The industry knows this. At NACS's 2025 annual conference, the message to operators was explicit. The future of this business is inside the store, not at the pump. Expand food service, add car washes, reduce dependence on the product the business is named after. There's one wrinkle that isn't purely bad news. EV drivers enter convenience stores 45% more often than gasoline customers and spend more per visit because a 20 to 30 minute charging session is 20 to 30 minutes spent inside a store with nothing else to do. The catch is that retrofitting a station for EV charging is another significant capital outlay stacked on top of infrastructure that was already expensive to build. So here's where all of this actually lands. There are 152,000 gas stations in the United States right now, down from over 200,000 in 1984. The count has declined for 2 consecutive years. Margins on fuel are too thin for small operators to compete with chains that can extract better wholesale pricing and fund the food service build-out, now generating nearly 40% of the industry's gross profit. Yet 60% of U.S. convenience stores are still run by operators with 10 or fewer locations, running the same low-margin product as the giants, with none of the leverage.
Strip away the branding, and a gas station today is really 3 businesses stacked on top of each other at aging different speeds. The fuel business is flat to declining and was never designed to be profitable on its own. The convenience store business is the one actually generating the return and has been quietly taking over the balance sheet for 20 years, and the environmental liability underneath both of them doesn't care which of the other two is performing well. It activates the moment a pipe cracks on nobody's timeline and attaches to whoever's name is on the deed that day. That third piece is the one that actually determines whether this is a good business to get into, not the fuel margin, which everyone already knows is thin. The real underwriting question is how old the tanks are and whether the site has been tested. That's the question due diligence has to answer before the other one even matters. The gas station predates the interstate highway system and isn't disappearing overnight, but the business under the sign has already changed once, quietly, from a fuel company into a retail company, and it may be starting to change again into whatever comes after the pump stops being the reason people stop. Whether that transition ends up being the end of this business or its biggest opportunity in 50 years comes down to which operators saw it coming early enough to build for it, and which ones were still betting everything on the thing the business happens to be named after.